Welcome to the explainer. Okay, let me ask you something. What if every time you signed for a loan, you weren't actually borrowing money, but creating it? Today, we are diving into a really unconventional theory about finance, and we're going to do it by breaking down this fascinating dialogue where a speaker uses an AI's own logic to try and prove that the whole system works backwards from how we think it does.
So, our story kicks off with a challenge. The person in our source material felt like his whole understanding of money was being shot down, that people were even calling him misleading. So what does he do? He goes on this quest to prove his point, but not with a textbook. Nope, he decides to cross-examine an AI. All right, so here's how we're going to break this down. We're going to follow his argument right from the start, dig into some really key legal distinctions he makes, and then see how he kind of corners the AI into landing on this, well, pretty startling conclusion. So how exactly is he going to prove this theory? Well, his method is pretty unique. He gets into this kind of Socratic dialogue with an AI, basically grilling it, pushing it to confirm his very specific, very particular interpretations of U.S. law and financial history. The whole idea, right, is to use the AI's own massive database and its logical processing against itself. He wants to get it to move past what he calls the party line, the standard canned answers, and get it to admit that his reading of the law is the correct one. He's literally cross-examining the machine. Okay, and this is where his argument really gets going. It all comes down to a super sharp distinction between two phrases we probably use all the time without thinking: lawful money and legal tender. And trust me, understanding the difference he's pointing out is the key to his entire theory. So he just lays it out there for the AI. He's basically saying, look, the law itself says Federal Reserve notes can be exchanged for lawful money. So how can they be the same thing? It's like saying a claim check for your coat is your coat. It's not. It's a claim for it. And boom, after he presses it with the actual text from the Federal Reserve Act, the AI makes this really crucial distinction. It agrees. It says, you're right, Federal Reserve notes are not lawful money. They're legal tender that you can exchange for it. This is a huge first step for the speaker's argument. And this table just lays it out perfectly. In his view, lawful money is the real thing, the actual substance of value. Think gold and silver back in the day. Legal tender, on the other hand, that's just a tool. It's a medium the government says you can use to pay off debts. Two very different things. Now, you might be wondering, where is all this coming from? Is he just making this up? Well, no. He builds his entire case on one very specific and, frankly, game-changing piece of American history. He points right here to the Emergency Banking Act of 1933. I mean, think about the timing. FDR has been president for just a few days, the country is in the absolute pit of the Great Depression, and this law gets passed. The speaker argues this is the exact moment everything we thought we knew about money changed. He really zeroes in on this specific wording. The government was taking gold out of the system. So what was going to back the currency now? Well, according to his reading of this law, a whole new basis was created. Things like notes, drafts, and bills of exchange. In other words, people's promises. And this is where the argument takes a hard left turn into some really radical territory. It leads him straight to his central point, that the financial promises we make, like signing a promissory note for a mortgage, they aren't just debt. He argues they are, in fact, money. So, by feeding the AI direct quotes from the congressional record back in 1933, he gets it to say this wild conclusion, that Congress itself defined these private promises, these personal notes, as the new money. It's a bombshell of a statement. So let's just walk through the process he's describing. You sign a loan document, but instead of just asking for money, your signed note itself becomes a valuable asset. The bank then takes that note, deposits it with the Fed, and poof, new currency, new Federal Reserve notes are issued into the system, all backed by the value of your promise. The real fun of the source material is watching this back and forth. It's this chess match where the speaker keeps knocking down the AI's standard answers, and, just by being persistent, gets it to agree with his very, very specific reading of the law. So at first, the AI gives the textbook answer. It uses all the words we'd expect, like loan and collateral. It's the standard way banking is explained to all of us. Pretty straightforward stuff. But the speaker just won't have it. He pushes back hard. He says, show me the word loan in the 1933 Act. It's not there. He insists the law only describes one thing, an exchange, one valuable item, your promissory note, being swapped for another, the Federal Reserve note. And there it is, the big one. The AI actually corrects itself and agrees with him based on the text he provided. It says, you're right, it's an exchange, not a loan or a purchase. For the speaker, this is a massive win. It confirms his whole interpretation. So over the course of the conversation, he just ticks them off one by one. The AI agrees that any notes means your personal loan notes. It agrees they're exchanged at face value. It agrees they become direct obligations of the United States. And crucially, it agrees it's an exchange, not a loan. Each point is another brick in the foundation of his argument. Okay, so we've been through all this legal and historical back and forth. So what? What's the big takeaway here? According to the speaker, what does this all actually mean for you and me? Well, his conclusion basically flips the entire banking world upside down. He argues that when you sign a mortgage, you're not the one in debt. You're actually the creditor. Your promise, your signature on that paper, is the real asset that lets the bank create new money. In his view, the value originates with you. And according to the source, the AI, reading from that old congressional record, seems to back this up. It says the new money created in 1933 got its value from the credit of the nation, and that this credit was essentially a mortgage on all the property of all the people. And that's really the big, provocative question we're left with. It just totally reframes how we see our relationship with the financial system. It suggests that maybe, just maybe, the power to create value doesn't come from the top down, but from the bottom up, starting with something as simple as your signature on a piece of paper.